Hello, and welcome to Investment Insight, your clear take on the markets. Let's get started.
It's good to be here. And frankly, considering the absolute roller coaster of a week we just had, I think we have a lot to unpack.
That's putting it mildly. I mean, if you're listening and you checked your 401k recently, you probably felt that pit in your stomach.
Oh, yeah.
It wasn't just that stocks were red, it was, well, everything. Usually we have this comforting rule, right? When stocks go down, safe stuff like bonds goes up.
The classic hedge.
Exactly. But this week, that just snapped. Stocks fell, bonds fell. It felt like there was nowhere to hide.
It was a very rare, very specific event. A lot of people are calling it a perfect storm.
A term I usually hate, but...
Me too. Gets thrown around way too much.
Yeah.
But looking at the deep analysis we got today, it actually fits perfectly. This wasn't one big thing.
Right. It wasn't like a single housing bubble or a pandemic. The research suggests this was, what, 3 completely different things all hitting at once?
That is the only way to view it. The data shows it was a convergence. You have a geopolitical clash in the Arctic with President Trump.
Okay.
Then you have a sudden monetary shock out of Japan. And to top it all off, a really weird symbolic move from a pension fund in Denmark.
So our mission today is to untangle that knot, to explain how an icy island, a Japanese election, and a Danish pension fund all conspired to shrink your retirement account.
And this isn't just, boring finance news.
No. This is a story about how global politics is suddenly changing the value of your portfolio. So where do we start?
We have to start with the ice. We have to start with Greenland.
Okay, Greenland. I mean, on the surface, this sounds ridiculous. Most of us think of it as just a big block of ice on a map. How does that crash the S&P 500?
It does sound absurd if you think of it as a real estate deal.
Yeah.
But according to the analysis, this isn't about buying land.
It's about something else.
It's about the rules of the game. When President Trump linked the offer to buy Greenland directly to tariffs, he changed the entire nature of the conflict.
Right. He basically said, sell us the island or we put tariffs on your goods. Which sounds like classic hardball negotiation. Why did the market freak out this time?
Because the European Union didn't treat it like a trade dispute. Usually, we argue about steel or cars.
All right, it's transactional.
Exactly. But the reports show that Brussels is treating this as economic coercion.
Economic coercion. That sounds a lot more serious. That's not let's make a deal language.
Not at all. It's you are bullying us language. And because of that, the analysis shows they're dusting off this new legal weapon.
A weapon?
Yeah, they call it the Anti-Coercion Instrument, the ACI.
The ACI. Okay, what does that actually mean for, say, a business in Ohio?
Think of it as a nuclear option for trade. It lets the EU retaliate immediately. They don't have to wait for courts or anything.
So they can just bypass the whole system?
They can freeze American assets, block investments, you name it. The analysis is talking about a potential retaliation package worth up to $100 billion.
$100 billion. So this isn't just about making French cheese more expensive. This is a trade war on steroids.
It's worse. It's a diplomatic freeze. The EU Commission President, von der Leyen, she signaled this is not a bluff. She's talking about a full policy package for the Arctic.
So she's digging in.
And that's what hits the market. Investors hate uncertainty, but they absolutely loathe it when allies fight like this.
Because our entire economic system is built on the idea that the U.S. and Europe are, on the same team.
Exactly. This creates what analysts call an uncertainty premium. If you can't trust the basic rules between the U.S. and Europe, then every multinational company, Apple, Microsoft, Ford, is suddenly a riskier bet.
And when risk goes up, the stock price has to come down.
That's it. So Storm System 1 is the breaking of the Atlantic Alliance. Now let's pivot.
To the other side of the world, Japan. I always think of Japan as, the stable, maybe boring part of global finance. What happened?
The quiet uncle just stood up and started shouting. So for decades, Japanese interest rates have been near zero, right?
Yeah, money was basically free there.
Basically. But this week, the yield on their 40-year government bond, the JGB, smashed through 4%.
4% might not sound like a lot to us with our mortgage rates.
I know, but in Japan, that is seismic. It's like the San Andreas fault just snapped.
And this is tied to their politics. An election is coming up.
Yes, the general election on February 8th. The leading candidates are promising things the bond market hates. Massive spending, huge tax cuts.
The classic vote for me, I'll give you free money playbook.
You got it. But bond investors did the math and said, wait a minute, Japan already has a mountain of debt. You can't afford this.
So they stopped buying.
They went on a buyer strike. And let's just pause here to explain bonds, because it's
Yeah.
so important. Think of it like a teeter-totter.
Okay, a teeter-totter.
Price is on one end, yield is on the other. If no one wants to buy the bond, the price goes down.
And the yield on the other side has to go up?
Precisely. Prices crashed, and yield skyrocketed to 4%.
Okay, I get why that's a disaster for Tokyo. But connect the dots for me. Why does a 4% rate in Japan make my U.S. bond fund go down?
This is the absolute key. Think of Japanese investors, pension funds, big banks, as a giant vacuum cleaner.
A vacuum cleaner.
For years, because rates were zero at home, their vacuum was pointed outwards, sucking up global debt. US Treasuries, Australian bonds, everything.
They were funding our deficit because they couldn't make money at home. They were the biggest customer.
The anchor of global demand. But now, if they can get a safe, guaranteed 4% return at home in their own currency.
Why would they send their money here?
They wouldn't. The vacuum cleaner just got put in reverse.
So it's sucking all that money back into Japan.
Exactly. And that leaves a massive demand void for U.S. debt. The U.S. government is selling trillions in bonds, and one of our biggest buyers just walked away.
Supply and demand. We have a ton of supply and demand just dropped. So to get new buyers, we have to offer higher interest rates.
And that's why U.S. yields spiked. It reprices the risk of lending money long-term, globally.
So we have the Greenland mess hitting stocks, the Japan shock hitting bonds. But there was the third piece, right? This Danish pension fund thing.
The wild card.
Yeah, this one stood out in the reports because it's so specific. One fund selling U.S. debt. Why is that a big deal?
It's all about the narrative. You're right, the amount of money wasn't huge. It didn't move the market by itself. But the symbolism,
It was signal.
it was seen as a warning shot. The story that took hold instantly was weaponizing finance. The fear was that someone in the EU was using their U.S. debt holdings as a bargaining chip in the Greenland fight.
That sounds incredibly dangerous.
It's burning down the house. Because the question in every investor's mind became, who's next? If a Danish fund does it, what about a German one? What about the French?
It turns the bond market into a battlefield.
Precisely. And I saw U.S. officials like Besant, they tried to calm everyone down, saying it was isolated.
But the damage was done?
Because in finance, perception is reality. Once you ask the question, is U.S. debt politically safe? You can't unask it.
Okay, let's put it all together. Alliance fight, rate shock, and a trust issue. That's the perfect storm.
That's it.
But I want to dig into the stock market part more. Why did tech stocks, the NASDAQ, get hit so much harder than, say, a utility company?
It all comes down to something called the discount rate. It's a bit technical, but it's crucial. Imagine I offer you $100 today, or $100 in 10 years. Which one do you want?
Today, obviously.
Right. Money in the future is worth less than money today. Now think about a tech company. Their stock price isn't based on profits today. It's based on the huge profits they promised to make in, like, 2035.
It's all about future potential.
Exactly. But if I can get a safe 5% return in a government bond right now, that future promise looks way less attractive. I have to discount its value more heavily.
So when the interest rates jump up because of Japan,
The math used to value those tech stocks just breaks. The denominator in the equation gets bigger, so the stock price gets smaller. It's almost mechanical.
so Apple's business didn't get worse. The math just changed underneath them.
That's the reality. It was political risk, plus supply and demand fears, plus that changing discount rate. That's the formula for a crash.
Okay, that's the diagnosis. So for our listeners looking at their accounts, what now? Do I panic?
No, you don't panic. But according to the analysis, the smart money is playing defense. This isn't the time to be a hero.
Don't try to catch a falling knife.
Couldn't have said it better. First piece of advice is simple. Cash is king.
Just plain old cash.
Or anything like it, liquidity. When stocks and bonds are falling, cash holds its value. It gives you safety and firepower for later.
Okay, so hold cash. What about bonds? You just said they were cracking.
The advice is very specific here. Move to short-term debt. Think T-bills, money market funds, things that mature in, say, 3 to 6 months.
Why short term?
They're just less sensitive to rate hikes. If you own a 30-year bond and rates spike, you lose a ton of value. A 3-month bill. You just hold it for a few months and get your money back. Easy.
Got it. Keep it short. And what about stocks? Are there any safe harbors?
The data suggests pivoting away from big tech and anything tied to global trade. Instead, you look at 3 areas. First, defense.
Aerospace, defense contractors.
Sadly, yes. If the world feels more dangerous, governments spend more on security. It's a pragmatic hedge against the very chaos you're seeing.
Makes sense. What's number 2?
essentials, consumer staples. People still need to buy toothpaste and food. These stocks are boring. But in a storm, boring is beautiful.
You want boring. And the third?
Gold. The classic safe haven. When you start to question the safety of government debt itself, like with that Danish signal, money flows back to gold.
Okay, so cash, short-term bonds, defense, essentials, and gold. That's the bunker. Are there any dates we should circle on the calendar?
Two big ones. First is January 22nd. That's the EU summit.
And we're watching to see if they escalate the Greenland fight.
Exactly. Do they formally announce sanctions, or do they find a way to de-escalate? That will tell us a lot about that uncertainty premium.
Okay, Jan 22. What's the other one?
February 8th, the election in Japan. Who wins, and more importantly, what does their budget look like? If they get fiscally responsible, the bond market might calm down.
And if they don't?
Then the vacuum cleaner stays in reverse, and rates could go even higher. The key lesson here is to wait for interest rates to stabilize. The stock market can't find a floor until the bond market does.
This has been a really eye-opening look at how this all connects. It's almost overwhelming.
It is. It highlights the new reality we're in.
And what's that reality? If you had to leave our listeners with one final thought.
I think it's this. We are entering an era where politics and interest rates are bundled together. You can no longer look at a company's balance sheet without looking at a map of geopolitical alliances first. The era of pure economics is over.
Wow, you can't just read the financial page anymore. You have to read the front page, too. The map matters just as much as the math.
Absolutely. The silos are gone.
Well, thank you. This makes the red on the screen make a lot more sense. It stops being a mystery and starts being a puzzle.
My pleasure. It's always better to understand the storm.
Couldn't agree more. That's all for this deep dive. Don't forget to subscribe and hit that like button. We'll see you next time.